Gold returns have exceeded 10% in the past 7 years, unbiased of the stock market upheavals and the effect of the pandemic, thus marking it as a must-have in your list of investments. Apart from the inherent stability of gold as an investment option, many people also include it in their portfolio to diversify their investments in a way such that it beats the average inflation. If you are still not sure why you must buy gold to ensure sustained growth in your portfolio, check how and why the yellow metal can help cool off the unwarranted heat and stress from the market. Unlike stocks and mutual funds, wherein you must account for various factors including price, valuation, expense ratio, returns rate over a period, portfolio turnover ratio, market capital, earnings, and more, investing in gold requires no such expertise. Gold as an investment has been in existence for aeons. The affinity for gold started with women buying jewelry during festivals and special occasions. The lack of liquidity coupled with the losses faced on non-retrieval of making charges prompted many to shift to paper gold. Then came gold exchange-traded funds that aim to track the market price of gold to allow people to invest in small amounts. These being passive investments are relieved from the active management and interference by fund managers. These funds invest in gold bullion and are therefore based on gold prices, thus allowing investors to decide their gold investments accordingly. Gold mutual funds are also good, though you might want to be aware of the expense ratios involved. However, it is their high liquidity factor that attracts most investors. Sovereign gold bonds, SGBs, are also an interesting way to keep your money parked, though you must opt for them only when you wish to invest in a lump sum. Imagine that you have earned lump sum profits from a business or sale of a fixed asset. One way can be to park in some government bonds that will yield moderate but stable returns. The other way out would be to put the money away in SGBs for at least 8 years. Though the tenure of these bonds is 8 years, you can opt for the encashment or redemption of the bond post-completion of 5 years. Moreover, instead of going to the bank to mark your investments, you can simply sign up with your details on RBI Retail Direct, which allows you to put money in SGBs from the comfort of your home. There are myriad benefits of parking money in digital gold formats like gold ETFs and gold mutual funds. One benefit is that you can invest in small amounts instead of waiting to accumulate a lump sum and then buy gold. Buying gold in very small amounts can be difficult considering how many gold retailer shops are apprehensive about selling this precious metal in such small quantities. The purity of the metal is again questionable. Gold ETFs, on the other hand, can be bought and sold in small amounts, thus allowing you to trade with small amounts. The same holds for investments in gold mutual funds too. Though the investments may seem small, these add up over a period to allow you a lump sum. This money can be converted into a sizable amount of gold or redeemed for massive returns. Putting money in SGBs or gold ETFs has tax benefits too. The burden of taxation is most in physical gold investments. This is because when you buy physical gold including jewelry worth more than 2 lakh rupees, you will not only have to pay 1% tax deducted at source (TDS) plus 3% GST on the value of gold. When you sell physical gold, you are subject to a flat 20% tax rate plus a 4% cess on long-term capital gains. Gold ETFs are taxed differently. Moreover, the burden of taxation is far less. How much tax you must pay depends on whether the gains are of short-term or long-term nature. If you are redeeming your gold ETFs within 3 years, the short-term capital gains are added to your income and taxed as per the existing slab rates. Holding these bonds for more than 3 years will amount to long-term capital gains, thus subjecting you to a 20% tax on the earnings with indexation benefits. This means that if the value of gold goes up by 10% every year while the inflation rate is 7%, then tax will be applicable only on 3% of the profits earned. This is far less than what pays on physical gold, thus explaining the need and urge to shift to digital gold. SGBs are completely exempt from tax. However, if you sell the SGBs before the redemption period, you will be subject to capital gains tax as per the prevailing income tax slab rates.